Hey guys, welcome back to the channel. My name is StockBroc. Today I'm talking about margin. Margin is basically adding leverage to your account. You're basically borrowing money from your brokerage, such as Charles Schwab, Fidelity, Webull, Robinhood, any of the above. You're basically borrowing money from your brokerage account. So that gives you more money to either invest in stocks or trade stocks. A lot of the times people use margin to trade because you are betting big or making educated guesses on where a trade is going to move. And you want to have more money to make more money. Let's break down what margin actually is in your brokerage account. So the main reason why people use margin is they want to amplify their returns. So basically, if you're putting up a larger investment, you can make more profit. And once you make that profit, you can cash that, pay back your loan, and pay back any interest, because you do have to think about interest for margin. And this is how you can make more money by using margin. But there's a lot more to it. So let's dive right into it. All right, so to break it down further, to open a margin account, most brokers require a minimum deposit, commonly around $2,000 or more. You can usually borrow up to 50% of the stock purchase price. Margin lets you double your buying power, but magnifies both gains and losses. So say if you put $10,000 into a stock and the stock goes down, you're still going to be required to pay back that loan. But say if the stock goes up, you can cash out that profit and then pay back what you owe on that loan. But you do have to keep in mind the interest that is going to accumulate. I think it's maybe every month, or I'm not sure how margin is charged, but I like to use cash because I don't want to think about having to pay back interest. And that's something as a beginner that I did not know about. So margin lets you double your buying power, but magnifies both your gains and losses. If the stock falls in value, losses are also larger because you're investing with borrowed money. All right, so going back to margin, this borrowing isn't free. It's accrued daily and it eats into your returns. So think of margin as eating up your returns. So if you're not getting high enough returns to beat out the margin return, you're basically going to be negative. And you got to also factor in inflation. So it's very difficult, and you want to be very mindful and very educated on your trades and make sure you know what you're doing before you get into margin. Also, don't forget to check around. Different brokerages have different rates, and those rates are changing frequently. So you can always shop around for different rates if you are interested in doing margin trading. Always remember that margin can be used for more than just stocks. It can be used for options, short selling, and futures. Margin can multiply both gains and losses, so beginners should proceed with caution. Always know your broker's rates, keep an eye on margin balance, and understand the risk before you borrow. Treat margin as a tool, not a shortcut, and use knowledge before leverage. And let's just kind of summarize what we spoke about on margin. Margin is borrowing money from a broker to buy more stocks or options or any other strategy than cash alone would allow. It amplifies gains, but also losses. You pay interest on borrowed funds, which lowers net profits. Margin calls can force you to add money quickly or see your assets being sold when you don't want them to be sold. Trading on margin involves higher risks. Losses may exceed your investment. It's best to be used carefully and with a solid understanding of how borrowing impacts your portfolio. Thanks for watching StockBroc. If you learned something, like it. Thanks. Peace.